Welcome to the Tomosi Business Training Series. The basis of these sessions is to support the Tomosi Group staff and management to raise their capabilities and performance. This is also a platform to share our experience with young entrepreneurs making an effort to build their startups in Uganda and across Africa. In this session, we continue to explore the principles of basic accounting. Enjoy!
Hello, my name is Ms.Agnes Aketch. Welcome back to Tomosi Business Training Series. Today we shall continue from where we stopped. We are still looking at training for non-accountant or training for non-finance personnel. Today's topic, we are going to look at what is accounting process. Hopefully you still remember the areas that we have so far covered. I'm just going to run through quickly. We have so far looked at what accounting is, who are the users, what information can be provided by accounting information or accountants, how the info can be utilized, and today then we continue to peruse through or look deeper into what this is like. Accounting process, as we all know, a process is the beginning and through to the end. Accounting process here, we're talking of identifying, analyzing business transactions. What takes place in this process is what we want to look at closely. The accounting process starts with identifying and analyzing business transactions and events. Transactions are the day-to-day operations or day-to-day activities that translate or has impact on financials. Not all transactions or events are entered into the accounting system. Only those that pertain to the business entity are included in the process. For example, in a day you may have earned revenue or generated revenue, but maybe part of the revenue was not part of the business or does not translate into business transactions. Perhaps is personal. For example, a shareholder could have done some consultancy through the business, but this is not really part and parcel of the business. So this revenue cannot be captured as a business income because it's personal finance. Or a shareholder or the director or the owner could have spent money on personal issues through the company. This has to be filtered because it's not part of the business or does not translate into activities carried out by the business. Another example could be a personal loan made by the owner. This also does not translate into a business and therefore it shouldn't be included into the books of account. The transactions identified are then analyzed to determine the accounts are affected and the amounts to be recorded. Of course, when we do what we call posting into the system or posting the transactions, you don't post each and everything that you've received. You first have to understand what impact this transaction has on the business before you do your posting. Like I mentioned above, said director's loan or personal loan cannot translate into a business and therefore you cannot capture it or you cannot consider it as a business transaction. The first steps includes the preparation of business documents or source documents here to mention. These are things like invoices, receipts, journals, payment vouchers. All these are supporting documents that have to be prepared before you do the posting, because in the process then you understand exactly what you're posting and how it will impact on the financials. 2, recording in the journals. This is a form of document or a template that accountants normally use before you do the posting. Journals are just basically a debit and a credit. You can analyze, it tells you how you're going to do your posting. It is a book, or it can be a paper or electronic, especially these days that we have gone IT, in which transactions are recorded. Business transactions are recorded using the double entry bookkeeping system. If you remember, we talked about the T account. That's what they call the double entry, the debit and the credit. They are recorded in the journal entries containing at least two accounts. That is one side debited and another one credited. To simplify the recording process, special journals are often used for transactions that recur frequently, such as sales, purchases, cash receipts, and cash disbursements. A general journal is used to record those that cannot be entered in the special books. Sales, hopefully we all know that when you render services, for example, Gideon's Men, if you offer the gardening services, you issue tax invoices. This tantamount to sales, and at the end of the month or at the end of the day, depending on the cycle of your accounting, you issue tax invoices to your customers, and in turn they are paid. Purchases, these are what we need in our day-to-day operations, what smoothen the services or the goods. You go out there to buy things that you need to ease in your work, and in turn you have to pay for it. So you're purchasing these goods or services. Other transactions are done in cash basis. You're either selling your services or goods on cash. Therefore, you issue a cash receipt or you receive a cash receipt, or disbursements, especially where staff have gone out, you spend on behalf of the company, or you're given money to spend for your transport, for coordinations. These are disbursements, which is either side. You either charge disbursement or you receive disbursement from your suppliers or customers. Transactions are recorded in chronological order as they occur. It also matters, you don't just wake up and begin posting. For example, we are in the month of July. You've left out the transactions in the first week of July, and you go posting for 30th or 31st July. Then it will have an impact on the financial reporting. It will bring distortion in the reporting system. That is why it is very important, if we are to drive our point home, that when we get out as managers and we implement activities, it's very important that you come back with your accountability in time to enable finance people or accounts people do the timely recording and posting of these transactions, capturing of information that in turn again will bounce back to you in enabling you make your right decision. Because, for example, if you've moved out, you've implemented activity in a month, and the month goes on, you have not submitted your accountability, and yet at the end of the day, you'll need this report to guide you in the next business or next venture that you need to take. And just because you did not submit your accountability in time, financial people are not able to give you the right report or the correct report or timely report. Therefore, your decision making will at the end of the day be affected. Posting to the ledger is yet another process in accounting, also known as books of final entry. The ledger is a collection of accounts that shows the changes made to each account as a result of past transactions and their current balances. This is just like a pool, or it's like a pocket. You move out, you do something, come and drop the money or drop the document, At one point you want to pick this document, get out, go utilize it, come back. So it is a pool that at the end of the day tells you what exactly has taken place in a month or in a particular period in time. So likewise in accounting, for example, sales ledger will tell you in the month of July, this is the number of sales that you generated in that particular period, or this is the number, or this is the amount of expenditure you've incurred in this particular period. For example, if you're running a fuel ledger, you know that you've been fueling every day or every week. Every time you go to fuel, you're issued a voucher. That voucher is captured, is part of the source documents that is utilized by the financial people or the statement. So at the end of the day or at the end of the month, we'll wake up and say, okay, in a month, how are we faring on the fuel consumption? Not until you've provided some of these source documents, then accounts is able to give you the report on fuel. How did you consume fuel vis-a-vis the work that you've done? Was there value for money? All this information are important, and that's why we're saying all this is captured in the what? In the ledger. So the ledger is just like a pocket or a pool that keeps all your information. At the end of the day, you can analyze on a day-to-day, on a monthly basis, on a yearly basis, and see how you've performed within a given period of time. For example, all journal entry, debits and credit made to cash would be transferred into the cash account in the ledger. We'll be able to calculate the increases or decreases in cash. The ending balance of cash can be determined. Just like the example I gave in the fuel, at the end of the day, the business owner or you who is entrusted with running the business, you want to know whether the business is healthy or not. And how do you know that? By the money that has come in and that has gone out. If at the end of the day, you've not provided or accounts does not have what it takes to generate this report, then we run a blind business that no one can tell the direction in which the business is going. The fourth bit of this is unadjusted trial balance. We all keep hearing about trial balance, and sometimes you wonder what is a trial balance. If you're familiar with the legal bit of it, the symbol that legal people normally use, there's normally a symbol that balances on both sides. It's like a pulley or something like that. So the trial balance is also in this case it's just like a T account. The other side tells you the debit and the credit, and all these things have meanings. And there's always a question that must a trial balance? Yes, it must balance. But the second thing is, if it has balance, does it make sense? Because we can always force it to balance in any way. But at the end of the day, if it is not built on source documents, true transactions, then at the end of the day, the report will be meaningless, will be unrealistic, because there's something that is cooked inside there that does not make business sense. So a trial balance is prepared to test the equality of the debits and credit, the balance. Where do we get information to build our trial balance? We picked it from the ledgers, which I had earlier on talked about. So in the ledger, you'll find the sales has its own ledger, purchases has its own ledger, the loan has its ledger, the cash has the receivable or customer balances, suppliers, all the transactions that take place in accounts. Most of these have their own ledger, has their own pool. So at the end of the month, at the end of the day, or at the end of the year, when accountants prepare this, these balances must have been generated from somewhere which has a true source, it has integrity, not just picking figures when you cannot defend. And all in all, this affects all of us. That's why this training is very important, that even when you're not involved in accounting, even when you don't sit in finance, as long as you're in a business, this, in one way or the other, the work that takes place in accounts affects your work, and your work equally affects finance. So it is very important that every personnel or every employee in a company must take interest into what takes place in accounts and how we balance off, or how we equal each other's work. We must be mindful that every decision I take in my department or in my company, as long as it has financial impact, then there's a reason for you to pick interest in how that affects the finances of the business. It's only in that way that the business can grow and prosper. So the trial balance is built from the balances that is picked from the ledgers at the end of the day, and is arranged in one report. Afterwards, all debit balances are added, all credit balances also are added, and total debits should equal to total credits. This is a common saying in finance that for every debit there must be a credit. I can tell you, for example, if you make sales, if you engage a new client and sign a contract and you render the service and you paid, you have to capture this. And how are you going to capture this? Once you've captured your sales, you cannot leave it like that. That means there must be a corresponding entry somewhere else. So if you've rendered the sales, why were you selling anyway in the first place? You are selling these services or goods in order for you to earn revenue. And when you earn this revenue, where do you take it? It must be put somewhere, in some ledger, some pool, somewhere. So when you raise your tax invoice or the sales invoice to your client, definitely there's a corresponding entry. Sales has a credit balance. Then there must be a debit. If this customer has paid you by cash, that is cash sales, you're going to debit your cash because you've received it outright, and you're going to credit your sales. So you now see the T account, or you see now the trial balance, the debit and the credit we are talking about. So the same amount of money that you've captured on your invoice on the credit side must also be captured on the debit side. If it is cash sales, that means this money is going to the bank. Should you receive this money and use part of it before taking it to the bank, or you don't even capture it anywhere, and yet you've recognized your sales, you've captured your sales, then you say you've made a sale or rendered a service of 2.5, then this client pays you. Before you come back to office, you say, let me pass by and pick something. So you pluck over 100,000. So you remember you've issued this invoice to a client of 2.5. Now you must come and record the sales of 2.5. But if you don't bring the cash of 2.5 to the accounts department, accounts is going to receive and record exactly what you brought. If you brought 2.4, they record 2.4. And yet the sales you're saying is 2.5. You see already the gap there? There's already 100,000, which is not recorded anywhere. And this brings incomplete entry in the financial report. So how does the accountant explain this? If you've not given it to me, I'm not going to record it because I did not receive this money. So this only does not affect your transaction there and then. It will go on and on. It has a multiplier effect. This money has not reached the bank. That means at the end of the day, when we are reconciling the bank, even your bank balance will refuse to balance. You will say, no, for me, I did not receive the 100. You only bank 2.4. The other supplier has issued you payment of 2.5. If it's someone who is registered for VAT, they will file and record that we have sold to Tap or Gideon's Men. They have rendered us a service, we have purchased a service or goods from Tap or Gideon's Men of 2.5. Now we are going to record the sales of 2.5. But because we did not receive the 100, it is already having an impact on the cash or on the bank balance. And this is how sometimes businesses fail because of accountability, because of dishonesty, because we don't want to follow this simple debit and credit. So this is very important. If you spent it, please bring the accountability so that when the accountant is recording, we say, okay, we've made sales of 2.5, the client paid everything, but 2.4 is banked, 100 was already spent. But this is not the right way of doing accounting, especially if you want to be a professional business or company. They say you must learn to be disciplined enough to record your sales and bank your cash intact, so that at the end of the day, the audit trail is very clear. At least I know I made these sales and this was the respective income or revenue we have earned from this. So that is why everything that we do, whether you're an accountant or not, there's direct or indirect impact on the work you do and on the work that accountants do.
Enjoyed this session? We would like to hear from you. Please give your feedback using the Google form attached or email us at info@tomosigroup.ug and visit our website on www.tomosigroup.ug or tune into the Tomosi Business Series on Facebook and YouTube to enjoy more of our weekly training podcasts. You can also visit our offices at Tomosi Business Park, Luzira, Port Bell Road, or call 0789 901 356.